I think right now, if you look forward, you have to say tariffs are coming, are here, are going to be here. It's just incredibly hard to know exactly what it's going to be. So I think the concept of tariffs, sure, but the reality of what specific tariffs on what specific countries at what specific percent on what specific goods, we don't know.
Hello and welcome to the week ahead on Nomura Podcasts. I'm your host Andrew Ticehurst from our Global Markets Research team, and today's Friday, the 7th of February. Well, this past week began with surprising news that Mexico and then Canada had secured at least a 30-day reprieve from US tariffs. The US did impose a blanket 10% tariff on China, but the response from China has been judged as measured, and when asked about this, President Trump himself suggested that was fine. This has supported broad market sentiment and led to some weakening in the US dollar. But as you'll hear this week, we think the president is not bluffing and more tariffs will come, so it's far too soon to sound the all clear. Elsewhere, this week also brought us stronger than expected earnings data in Japan, which added to expectations that the Bank of Japan has more work to do in raising its policy rate, currently 0.5%, and supporting the yen and weighing a little further on the US dollar. This week, I'll check in with my research colleagues around the globe to get their take on these latest developments and to understand what it could all mean for their regions and what could come next. We also have some inflation data, plus a number of central bank speakers and a likely rate cut in the Philippines to look out for as well. More than enough there to keep us busy, I think, so let's dive in. So, starting with the US, I'm joined here by Jeremy Schwartz from our New York-based research team. Hi, Jeremy.
Hey, Andrew. Great to be back.
Excellent. Thank you. Look, let's start with tariffs. Big developments this week. What's your best guess going forward?
Yeah, so Trump, surprised late last week and over the weekend by announcing 25% tariffs against Canada and Mexico and 10% tariffs against China. Now, through negotiations Monday, the 25% against Canada and Mexico ended up being postponed 1 month. And the market certainly took that as a sign of relief. But we would note the increase did go into effect against China. And this would be one of the largest single tariff increases throughout Trump's 2 terms now. The breadth of a 10% increase that also includes consumer goods is pretty substantial. And then on top of that, we would note that Trump ended China's de minimis exemption, where small value items were exempted from tariffs. That's potentially very disruptive to logistics and the Chinese retail sector, which has really increased tremendously in size over the past couple of years. So again, I think the message that Trump has largely backed down, while certainly true from a market sentiment perspective, it seems to miss a little bit of the underlying increase and the fact that this was a fairly aggressive action in the grand scheme of things. Going forward, we continue to expect broad across-the-board tariffs against many of the U.S.'s trading partners. And in particular, whereas previously we thought Canada might escape unscathed, we think that now that they're in Trump's crosshairs, they're more likely than not to see some tariff increases. So we do expect more increases from here. We expect the inflationary impact is likely to be felt by the middle of the year. And that's a big reason why we're anticipating that the Fed is going to have to remain on hold throughout the year and really won't have the opportunity to cut while realized inflation is being driven higher.
Okay, got it. Thank you. And just on inflationary impacts, probably too soon to see impacts just yet, of course. But US CPI data for January is out next week. What are you looking for on that one?
Yeah, so we expect core CPI inflation likely rebounded to just around 30 basis points in January. So it's a little bit of a mixed bag. It depends on the angle you look at this from. The one hand, it's likely to be a sequential increase. But at the same time, after very strong Q1 prints over the past couple of years, this might come as a little bit of a relief, where you're not getting that same seasonal pattern where inflation picks up sharply to start the year. We do continue to think there's some residual seasonality in the inflation data. And in particular, there's also a January effect where some service prices are just updated once per year, and that gets reflected in January. But we think that effect is diminishing over time. So even though you're picking up in monthly terms, we do expect that the year-on-year inflation measures can actually start to make some progress.
Understood. Thank you. Look, finally, Jeremy, we do have Fed Chair Powell and a few Fed speakers out next week. I played a clip there at the top from Thomas Barkin reflecting on the uncertainty right now. But what could we hear from the Fed Chair next week?
Yeah, so I think uncertainty is exactly the right framework for how to think about Fed communications here. There's a lot of disagreement on the FOMC about just how much easing might be appropriate through the year. But we do see fairly broad consensus that policy should remain on hold for now. So it's actually a fairly straightforward message, which we're expecting from Powell, and really kind of echoing some of his comments from the January FOMC, where they think that policy is in a good place. They think they're prepared to react to data as it comes in, and that they're not necessarily going to anticipate Trump's policy actions and the impact that might have on growth or inflation, but rather they'll kind of keep an open mind, remain data dependent, and wait and see before they can get a little bit of clarity that cuts through the uncertainty.
Okay, Jeremy, that's great. Thanks so much.
Yeah, thank you.
Now let's jump across to Europe, and I have Andrei Stepaniak from our Europe-based research team here with me. Andrei, let's start with tariffs. We know that Europe is in Mr. Trump's sights. How bad could it be, and would Europe push back?
Hey, Andrew, great to be talking with you. I mean, look, it could be pretty bad. Essentially, tariffs, we think that US tariffs in Europe will hit European growth. So in our assumptions, we estimate about 10% tariffs, blanket tariffs, and that could be a 30 basis point hit to European GDP growth over the course of 2025 and 2026 cumulative. Now, bearing in mind that's only the direct impact, whereas obviously uncertainty can be far greater. So that can be another hit to growth. So that's bad on that front. Everyone's then thinking about the risk of retaliation, and obviously the European Union, it's a customs union, and so it's retaliation in the purview of the Commission, but everyone's talking about the fact that Europe could very well likely push back and retaliate. We think they will, but then what does that mean for inflation? We don't think it'll be very inflationary, in fact. The reality is manufacturing firms here struggle materially with firm pricing power because demand for manufactured goods is so weak. Tariffs are a cost to firms, so firms are going to have to absorb those costs. So when it comes to the ECB's perspective, they're going to be worried about that hit to growth more than the risk of the inflationary pressures in Europe. And let's not forget as well that tariffs, the US tariffs on China, that's deflationary for Europe. So essentially you have the direct hit to growth, you have the uncertainty hit to growth, plus deflation coming in through China. That's all more equally more dovishness from the ECB, all else being equal.
Okay, goodness, got it. Okay, let's turn to the Bank of England. We've just seen them deliver a widely expected rate cut, but I noticed that the pound sterling fell a little in response. I wanted to ask, were there any surprises in its communication, and where to from here for bank rate?
I mean, it was a pretty muddled BOE decision. So as you said, for example, the bank rate cut, unsurprising. What was surprising was the fact that one of the most hawkish members of the committee last time round, this time went and advocated for a 50 basis point rate cut. Now, that was a huge shock to everyone. Maybe it shouldn't have been so shocking. She had been talking about this idea that she's not hawkish or dovish, she's an activist. And basically, when she starts advocating to cut, she'll want to cut. And obviously, we saw that in the meeting today. The question is, does this raise the risk of cuts between monetary policy reports? Yes, it does. But we think the chorus of the committee are going to sort of maintain that sway. Hence why we still expect only quarterly cuts at the MPR meetings, and we see a terminal rate of 3.5% by February next year.
Okay, got it. Thanks. And finally, Andrei, just on the week ahead, I see we have another Santex survey and some ECB and Bank of England speakers. Is there anything within that lot that you'd like to shine a light on?
Sure. Look, in terms of the Centex survey, obviously it's the first activity survey of any given month, so it's worthwhile seeing what happens there. We think it's going to deteriorate further on the back of this continued US tariff uncertainty and the fact that Trump will one day say tariffs, the next day say no tariffs. And so we think that's going to obviously weigh on sentiment quite a lot. In terms of the BOE speak, We want to know it's actually Catherine Mann talking. So it'd be fantastic to hear from her rationalization from going to advocating in the previous meeting no rate cuts whatsoever to now a 50 basis point rate cuts. And from the ECB, it's all about neutral. They're releasing a new big paper on where they sort of update their estimate of the neutral range. And Nagel will actually be talking all about neutral. Given he's a hawkish member, it'll be interesting to see where he sees neutral and where he sees the ECB's terminal rates.
Okay, got it. Andre, excellent. Thanks so much. Let's leave it there.
Thanks, Andrew.
Now let's turn to the broad Asia region, and I'm lucky to be joined here this week by Sonal Varma, Nomura's Chief Economist for India and AEJ. Hey Sonal, great to have you on.
Thank you.
Excellent. Yeah, no, you've been a great friend to the podcast, but I think this is the first time we've spoken on this one. So let's start with the elephant in the room, tariffs. We understand our House view. Mr. Trump is not bluffing. Higher tariffs will likely come. Now, I know you and some of your colleagues there have been looking at what that could mean for the broad region, winners and losers. Could you share some thoughts on that?
Yeah, sure. So the short answer really is very negative for the region because it's not just trade. There's tech tensions. You have rise of U.S. industrial policies and China's overcapacity. So really, the region is stuck in between the two powers. So when we think about Asian firms, I mean, they are closely knitted into the global supply chains, which means there's actually a large trade in intermediate goods within Asia. Asia's trade with Europe, with Latin America. So, U.S. tariffs on any part of the world actually hits Asia. Just to give you an example, U.S. tariffs on China, for instance, hurts Taiwan's electronic sector. Tariffs on EU, if they were imposed, will hit Singapore's chemical and pharmaceutical sector. Tariffs on Mexico actually hurts Malaysia. It also hits Korea's auto industry. So in an interconnected world, actually, U.S. tariff on any country often ends up hitting another country. As you said, there will, of course, be some winners from the supply chain relocation. So one of the analysis we had done based on a sample of 130 firms that shows that India and Malaysia should be the big beneficiaries from the latest round of supply chains. In fact, they have been benefiting in the last 5 years already. So we do think this trend is going to continue. On the other hand, we think Vietnam is actually the most vulnerable in the region to higher US tariffs. And also because under Trump 2.0, there will be more focus on third countries that have been used to bypass China tariffs this time. So Vietnam could come under the spotlight.
That's great. Look, it does sound quite complicated. It's such a big, diverse region. I think I heard you use the word ricochet at one point, and that really kind of captured it for me. Now, Sonal, just putting your India chief economist hat back on, we did have the budget there last week, and I wanted to circle back quickly. Were there any surprises or highlights to your mind from that?
No, largely in line. I think it was a balanced budget in terms of fiscal consolidation and the government providing more targeted growth support. The big highlight was actually the tilt in government's focus towards consumption and slightly less on capex. So they've announced personal income tax cuts for households to boost consumption, and they've kept public capex stable as a share of GDP. We think this is actually a reasonable thing to do because India is seeing a cyclical growth slowdown, and there are certain execution bottlenecks on capex. For the next financial year, the fiscal deficit is budgeted to fall to 4.4% of GDP from 4.8%. So the prudent budget means there will be more room for monetary policy to support growth. And finally, the budget also revealed the government's medium-term fiscal rules. So the plan is to move from fiscal deficit targeting to central government debt targeting over the next 5 years. So this, of course, gives the government more fiscal flexibility, although markets would have preferred clearer fiscal rules.
Okay, got it. And just sticking with India for a moment, looking forward, I see industrial production and CPI data will be out next week. What could those ones tell us about the economy?
So inflation data will actually be more important, and we expect some good news there with lower price pressures. So for CPI inflation, we're expecting that to moderate to 4.4% in Jan from 5.2% in December. This is mainly on account of lower food prices. Core inflation has been subdued in the 3.5% to 4% range for over 12 months now, and we think this trend will sustain. The IP data tend to be volatile, but we are expecting a moderation in the month of December. So still weak signals on the growth front and cooling price pressures.
Okay, got it. Now, aside from India, there are a few other highlights on the calendar for the broad region next week. But one that caught my eye is the policy meeting in the Philippines, the central bank there. What's the team looking for on that one?
So we are expecting a 25 basis point rate cut given benign inflation and soft household spending. This is going to be in line with consensus. And with this cut, BSP would have delivered 100 basis point in total cuts. Now, our view is we will get another 50 basis point worth of cuts in the first half of this year. And this is despite a hawkish Fed, mainly because BSP is a more orthodox inflation targeting central bank. So it's less sensitive to FX pressures as long as inflation is within target, which is our view.
Got it. That's great, Sonal. Thanks so much.
Thanks a lot, Andrew.
So, those are the views from us, and that's the week ahead, written by Andrew Ticehurst and the Global Markets Research Team, edited and produced by John Dalton. Thank you for listening to our podcast. If you did enjoy listening to the show or want to hear more from Nomura's economists, researchers, or investors, please like and subscribe to Nomura's podcasts on Apple, Spotify, and SoundCloud, or wherever you get your fill of podcasts. If you are feeling generous, please leave us a review, preferably a nice one. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log on to nomuraconnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision, and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice, nor is legal, regulatory, accounting, or tax advice, and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.